ETH's getting a little bit overbought, probably corrects a little bit, goes again, probably goes into the ETH merge. And I think the narrative is buy the rumor, sell the fact. And what we'll get is like a cheeky 10% correction. And it's like, see, we're going to be able to buy it back at the lows, and it's going to rip everybody's heads off. Everybody I spoke to was starting to say, well, it's going to go down to new lows, it's going to be an earnings recession, blah, blah, blah. And it became the predominant narrative. That's okay. But the issue is, I did a tweet poll last week or the week before. I said, how many of you think we're going to new lows? Out of the 25,000 people who answered the poll, 70%. I then said, how many of you are underweight versus your normal equity weighting? 75%. And then we look at the BOA survey that is as bearish as it's max bearish for 9 possible weeks, and the market is just ripping in a straight line. And that's telling us still nobody's participating. So I've labeled this the most hated rally. It's the same in crypto, same in macro. These rallies are utterly hated. You know, there's narratives the market is tied to. It's tied to, and I think you and I share all of these, I think. It's tied to oil is going up only, it's going to $200. Inflation is going to be super sticky. Equities are going to go to new lows. Crypto is going to go to new lows, and bonds are dead money. And I just very much like the other side of that. It's still to this day underweight. All of the hedge funds are underweight. Most market participants are underweight, and people are getting angry and bitter on Twitter. So I note that same dynamic is there. The ETH merge is a really, really big deal, and I talked a bit about this because not only is it, you know, the supply and demand story, blah blah blah, but it's actually going to create the benchmark yield for the internet, for Web3, and everything should be ETH plus 300 basis points or whatever it is, as we do with treasuries, because we've got the benchmark yield for everything. It's really interesting. I think it's a very, very big deal for institutions. It's a very big deal for the pensions fund industry who want yielding assets. It's very big deal for DeFi. So I think the market is massively underpricing the long-term impact of what is going on right now. I think this is the biggest innovation and change in this space since stable coins, and then before that Ethereum itself. So it's of an order of magnitude of that. So buy the rumor, sell the fact. The cryptos, because the macro narrative is changing. If the macro narrative was still inflation going up, rates going up, then I would say, yeah, there's not much chance. Or M2 falling, the rate of change of M2. But that whole shift is starting to get priced by crypto. So I don't see how it goes down. I just don't see it. So I'm extremely bullish, you know, as you can tell, and it's an uncomfortable place for me to be so bullish equities into a recession, but that's where I am. I'm very bullish bonds, and I'm extremely bullish crypto. I managed to catch the low pretty much to the day, and yeah, ETH's up over 100% in a month. It's crazy, but we've barely started. Everybody's underweight. We've got this massive supply shock, demand shock, and complete shift to the market. So there will be volatility. It will suddenly see these air pockets of down 10, 20%, really sharp, and everyone's like, see, it's all going to fall apart. And then I think it rockets higher. Is every day you bring home wages, go back to 2021. If you were young and you wanted to invest, you put it into crypto, this dollar cost averaging world. And then what happened was inflation came along and everyone was too busy paying the rent and paying for their vegetables in the supermarket, and they couldn't buy any crypto. So you saw the amount of new funds going into crypto falling with the same number of active wallets, but just falling. So if you take inflation away, incremental money flows into crypto market. So I think crypto saw it. It was something that helped me again get the low. Is I saw the turn. We knew it was coming, right? We probably got it. Both of us probably got it wrong last month, expecting the turn in CPI, but the crypto market said it's here, and I think that was dead right. My view is economy lower, but it's priced into equities. People like Yuri and Timmer, who we had on recently, is like, we could have another leg because earnings come down. And my argument with that is, I don't know real earnings versus nominal earnings. Not sure how that plays into it. And the last two times we had high inflation and growth went negative was 1990 and 1982, and the market didn't have the earnings leg lower. So some people say, yeah, but in 82 the PE was 7. Well, 1990 wasn't like that. So the market had been ripping higher for a decade, with the pause in 87. So I don't think it's necessary. I think it's observable that it happens, but not always necessary. So I don't know, but I don't fear it, is my point. Generally, it's not my base case. Even if we do re-rate earnings, I think the market just raises the PE. So my view is we go into recession. It's pretty nasty. It's pretty quick. And the bond market's right to start pricing in a change in Fed policy at the turn of the year. They'll probably go on pause beforehand, by which case, and again, you've been tweeting about this and I've been tweeting about it. All of our work both suggests that the ISM is going to go hurtling through 50 in the next 2 to 3 months, which people aren't really prepared for. They're trying to tell people. They kind of know, but I don't think they are. So I think they're going to try and sell equities on it when it comes out. And that's probably going to be a very big mistake, because equities because the bond market's kind of telling us what needs to happen. But there's still a few factors in place that aren't fully in place. I think both you and I would love to see the oil market sort of break these $85 level, because I think it comes down to about 60. Then the year-on-year rate of change would be negative 50%. I think we get negative inflation in 18 months' time. And then we also want bonds to really properly break this kind of, I think it opens it up to 2%, 1.5%, 1%, depending on how deep the recession is. We all go back and look at history, but the hard thing is it's hard to remember the psychology of the period. All we've got is the charts that's left. So the psychology now is there are two big weights on the market. One is the inflation narrative. So when you take that away, the market's going to rise. The other weight is, what does the recession do to the market? And people are looking at recession as, recession is when earnings collapse, there's another leg down to markets. That could be right. None of us owns a monopoly on the truth here. We're just trying to probabilistically frame it out. And probabilistically, I think that the markets in this current world, which is a post-interest rate world essentially, they know that the outcome is only one thing, which is stopping the increase of, firstly, stop the rate rises at no level at all. I mean, it's barely anywhere. Next is to stop the balance sheet. Then is what? It's 3 rate cuts and you're back to 0. So therefore, anything, most recessions, you need about 500 basis points of rate cuts. So what we've tended to do is use Fed funds down to 0 and then use the balance sheet for the balance, because there is a rough equation, or so the central bank thinks there is. So therefore, the markets, if there is a recession, have to price 500 basis points somewhere within this, and they're just forward looking and saying, well, the cowbell, more cowbell is coming. And it's probably right. We have had energy prices in the past, energy crisis and supply crisis. So the ones, and I've talked about it frequently on Daily Briefing and elsewhere, 1947 to 1949 was a supply crisis, because everybody came into the civilian labor force, demand shock. Supply shock was, guess what? Nobody had been doing anything, so there was no supply. So we saw 20% inflation. It went negative 18 months later, went back up again, and then settled down. The other one was 1974, which was a Arab oil embargo, and that was a massive supply shock. Obviously, the economy went down the toilet, and the equity market went down the toilet. The moment inflation turned around, equities ripped higher. So we've had the inflation tipping down. Then the other times where we had inflation, but not necessarily an energy crisis, are interesting. One was 1982. Which is, Volcker, the hero kind of narrative that goes on. Well, when we raised interest rates to 18%, everyone's like, he crushed the markets like a brave man. Yeah, the equity market went down 27% and shot up like a rocket ship all the way till 1987. The next time we saw inflation behind that of 1982 was 1990. 1990, the ISM collapsed to 35. The Fed were cutting rates eventually, but what happened was the market went down 20% only. So we've got a recency bias going on here. The recency bias is going to be driven by this commodity supply, ignoring demand. We've had examples in the past that are very clear to look at that seem to not be consistent with that. So there's the one analysis, the one only ever, was why inflation went up in 1977 through to 1982, right? That's what's in everybody's head. You see, it's going to come back from the money printing. They're all going to pay the price. That was the glory days of gold and the glory days of the commodity investor. You know, that whole thing is a narrative construct that was driven by demographics. It was never driven by some monetary inflation issue. It was driven by demographics. And so that demographic thing is not here today. So the probability of this, so again, I go back to another argument to add to that, is, okay, we had a massive demand shock in commodities, but no supply shock in the 2000s, going into 2008, because China came in, right? The biggest demand shock in our working lifetimes. Commodities ripped. I mean, they all doubled and tripled. What was inflation over that period of time? If you just said, if I said all commodities are going to go up 300% from here, what's inflation? Everyone's going to go, it's going to be 15%. You know, it's the end of the world. Gold is going to be at infinity. They've destroyed everything. The answer was about 2.5%. Because it's the rate of change that matters. And it's not just commodity prices. So then we talk about rents, owner equivalent rents. They're slow and sticky, but the housing market's falling apart. And they're linked to mortgage rates. They have to be, right? Because most people have a mortgage, rent out the property. Mortgage rates are coming down, and if we're both right that bond yields are going to come down, then mortgage rates come down. So that stickiness is what plays out in 18 months' time when inflation is back to zero again, in my view. So I don't see that probability. I spent a long time thinking about this, and I wrote a big kind of rebuttal in GMI last month on this whole thing, because I take it seriously, because there's a lot of really good people I really respect with this view, and I just wanted to approach it and say, is this the most likely outcome or not, without ever saying it's never going to happen. And I just came to the conclusion from all of the work that I did, kind of hundreds of hours of this stuff, is like, no.